Welcome to this explainer. We are jumping right into the latest Jefferies Greed and Fear report today. It's a massive 40-exhibit deep dive into the global economy. And rather than just reading off data points, we're going to use some of the most critical exhibits to map out a fascinating, real-time chain reaction in global macroeconomics. So get ready to connect the dots across borders, balance sheets, and bond markets.
So let's just push the very first domino here and ask the ultimate question hanging over the global economy today. What exactly happens when $40 trillion in government debt completely collides with a global yield crisis?
The sheer scale of this is honestly hard to wrap your head around. As of August 2026, total outstanding U.S. public debt officially crossed that staggering $40 trillion milestone. I mean, just look at the steepness of that curve lately. It represents an absolute unprecedented acceleration in national borrowing.
Section 1. Geopolitics and fiscal tremors. To figure out how we actually got to this mountain of debt, and more importantly, where we're going, we first need to look at the geopolitical and fiscal tremors shaking the foundation right now.
Starting with geopolitics, tensions have essentially choked off the Strait of Hormuz to most shipping. Because of that, the NYMEX diesel crack spread, which, as you know, is the price gap between raw crude oil and refined diesel, has absolutely skyrocketed past $100 a barrel for the very first time. It's not just an energy story, right? Expensive diesel means expensive shipping, which acts as a massive, immediate inflationary trigger rippling right through the global supply chain.
And back in the US, this global instability is colliding with a pretty brutal fiscal picture. The numbers are frankly staggering. The July deficit alone hit $432 billion, the highest we've seen since March 2021. Why? Well, tariff revenues basically vanished, actually dropping into negative territory due to refunding, while national defense spending surged nearly 20% year over year. Add all that up, and the 10-month fiscal deficit sits at a whopping $1.799 trillion.
The visual evidence here is stark. Just look at the U.S. fiscal deficit for the first 10 months of this fiscal year. It already easily blows past the entire deficit of the previous full year. We're essentially running pandemic-level deficits, just, without a pandemic to justify them.
Section 2. America's Treasury Trap. All of this borrowing to fund these historic deficits leads us straight to our second domino. How on earth does the government fund this without breaking the bond market?
The underlying tension is really building here. U.S. nominal GDP growth has been cruising near 6%, which is well above the 10-year Treasury yield. Historically speaking, when nominal GDP outpaces the 10-year like this, it's a surefire signal that long-term bond yields are going to be forced upward. And the market absolutely knows this. Recent 30-year bond auctions have hit yields we haven't seen since 2001.
So the crucial takeaway is how the U.S. Treasury is desperately managing this pressure. To keep those long-term yields from breaching critical, painful levels, like that psychological 5% threshold, they're leaning almost entirely on short-term debt. Gross T-bill issuance has spiked to nearly 85% of total marketable Treasury issuance. At the exact same time, they're doubling their buybacks of longer-term bonds. They are literally engineering the market to keep borrowing costs down.
Section 3. Japan's Yield Dilemma. Let's jump across the Pacific and see how this triggers domino number 3 in Japan. Because in macroeconomics, everything is connected.
To really grasp this dynamic, we need to look at the relationship between the ultimate borrower and the ultimate creditor. America relies heavily on foreign capital to fund its massive deficits, sitting on a record $21.3 trillion deficit in its net international investment position, meaning the U.S. owes the rest of the world far more than it owns abroad. Contrast that sharply with its biggest creditor, Japan, which is sitting on a massive international surplus of 560 trillion yen.
But Japan is facing some intense internal heat of its own. Despite somewhat soft, real GDP growth, take a look at their GDP deflator here. It recently spiked to 2.6% year over year. After literal decades of fighting deflation, this is a glaring, flashing red signal that inflation in Japan is getting entrenched.
Much like the U.S., Japan's nominal GDP growth is running hotter than their bond yields, about 90 basis points above the 10-year Japanese government bond yield. Because of this, the Bank of Japan is under massive pressure to raise interest rates. But here's the trap. Raising rates instantly hikes their own government's debt servicing costs. They are completely stuck between fighting inflation and managing their own massive debt load.
Because yields are shifting back home, Japanese institutions are feeling the squeeze to sell off their U.S. treasuries and invest domestically. The numbers don't lie here. Japan's holdings of U.S. Treasury securities have dropped notably, falling from a recent high of $1.24 trillion down to $1.12 trillion. The biggest foreign buyer of U.S. debt is stepping back at the exact moment the U.S. needs them the most.
Section 4. Equities, bonds, and gold. This brings us to the final domino, how global markets are actually reacting to this wild debt dynamic.
What we're seeing is a fascinating divergence. Over on the right side of the ledger, foreign investors are just pouring a record $919 billion into U.S. equities, mostly riding that incredible AI hype. But check out the left side. U.S. long-term treasuries are stuck in a brutal bear market, down 39% since March 2020. Capital is basically hiding out in the stock market while completely abandoning government debt.
But with central banks totally boxed in by these massive debt burdens, unable to hike rates without bankrupting their own governments, the Jefferies report points to what might be the ultimate hedge: gold miners. Right now, they're boasting a highly attractive 3.74% free cash flow yield.
This divergence in free cash flow really drives the point home. Notice the breakout on that blue line? That is the Philadelphia Gold and Silver Index. Gold miners are actually generating rising free cash flow in this cycle, completely outperforming the deteriorating trend of the broader S&P 500, tracking lower in black. While the broader market gets more and more expensive, gold miners are generating real, tangible cash.
Which leaves us with this final, critical thought to wrap up our explainer. In a world where governments can no longer afford the interest on their own $40 trillion debt without sparking inflation, and central banks are totally trapped by their own balance sheets, are your investments properly protected? Thanks for joining me on this deep dive, and definitely keep an eye on those yields.